here with you. I'm going to check in here with you now and again and look at your questions, okay? So what happened was Richard S. just said, is this webinar being recorded? It is now. Thanks for prompting me. Thanks for reminding me. Karen says, I've never heard of the blueprints. Okay, marvelous. You'll have the opportunity to hear about it today. Let's see. Willard says, how do you have confidence that there's enough volume and volatility for sitting on an option 6 to 9 months out so that the other income methods have time to work? Willard, that sounds like a question born of you already own the blueprint, and maybe you've only skimmed it. There is, when we buy an option that's 6 to 9 months out, we don't normally have the intent to hold it for 6 to 9 months. We don't have that intent. I'll explain later as we go on. Okay? Okay. Someone says that there's no video, only audio. Okay, let me ask here real quick, like, folks, are you seeing this? Does it say the players on the front? Does it now say the players? Yes? Bar says no. Johnny, Karen, Dick say yes. Okay, so Bars, it might be an issue with your computer. Okay, Steve and Juan and Ron and Richard all see it. Okay, I'm gonna go ahead and go forward and Bars, if you only listen, you'll still get something out of it. But maybe see about what might be the issue with your computer. Okay, all right, very good. Thanks for Larry and Ron also chiming in. Okay, so if we go to Vegas, the players in Vegas are these: the house, and the house is set up to win. The house is going to win. Okay, all right, good. Bars got it figured out. The savvy professional is also a player in Vegas, and he wins some of the time. In fact, he might win consistently. He might win very often. He's the savvy professional. So who finances those? The folks that finance those in Vegas are you and me. You know, unless you are a card counter, okay, unless you are a very, very savvy poker player, odds are that you make enough trips to Vegas or sit at enough tables or play for long enough, you're going to end up feeding the monster. You're going to end up with your money in the pockets of the house and the savvy professional, okay? Now, by playing against the house, we set ourselves up to be a loser. And that is how the situation is set up in Vegas, okay? So, in Vegas, by the way, if you are a card counter, a card sharp, you are going to probably have a talk with security. You might have a talk with this fella, Sal, you know, if you win consistently enough. Karen's laughing out loud. Okay, so let's talk about options now, all right? The market makers are set up to be, you know, in this analogy, they are the house, okay? They are the house. They're going to win. There are savvy professionals, and I like to think of myself as one of these. I am a savvy professional because I've consistently, over the last more than a decade, I've been able to make money in markets that are good and bad. All right, so there are savvy professionals, okay? But then who is it that feeds the other two? It's the rest of the market, okay? It's the patsies. And real quick, I'm just going to do a little examination of what we've been told, you and me. We've both been told this. And I'm going to get some feedback from you, okay? I'm going to show up a poll here real quick. But before I throw up the poll, I want to talk to you about what these promises really mean. Now, we've been promised 3 to 6% per month from our cover calls trading. I'm taking this verbiage right off of the #1 site, a gentleman whose name I won't mention, but his initials are Joe Hooper. Oh, whoops. Okay, sorry. But on compound stock earnings, it says 3 to 6% per month, consistently generated every month, regardless of market direction, and that you can either live off of that. You know, you can, if you have $100,000, boy, you can make $3,000 a month and live off of it, or maybe $6,000 if you're good. All right. Or you can reinvest it to dramatically compound the value of your stock portfolio. Okay, well, 3% per month, if you're compounding it, is 40% year over year. All right, over a period of 2 years, compounding at 3% per month would not be, that's 24 months, right? That would not be 72% gain. It would be 100% gain because of the phenomenon of compounding. And after all, that's our website's name, right? Compound your stock earnings, or compound stock earnings. Okay. If you were making 6% a month, you'd shortcut that to just 1 year. 6% per month over 12 months is not 72%. It's 100% year over year compounded. And that'd be 300% in 24 months. So that'd be, so either you're making 100% in 24 months, if you're at the 3% per month level, or you're making 300%, in other words, quadrupling your money. Start with 100 grand, end up with 400 grand that you can spend, that you can cash in right now. Okay, if we're being truthful about compounding, okay, that's what the 6% per month. So having said all that, having set the stage, I'm going to ask only our 24-month or longer covered callers to participate in this poll. Okay, only those of you that have consistently done covered calls for 24 months at a time. Okay, it doesn't have to be the last 24 months, but if you did it for 2 years in a row, or if you've done it for the last 24 months, let me know how you're doing. 3 to 6% per month would be, 100% gain from whatever you put in. And 6% per month would be a 300% gain, or quadruple what you began with. Okay. Now, so far, we don't have a lot of people participating in the poll because I purposely limited the field. Okay, I said, okay, only participate if you have done this consistently for 24 months or more. Okay. All right. So that poll has been up for almost a minute. I'm going to take a sip of my coffee here. Yummy. Okay, let me go ahead and close this poll, and I'm going to share the results. Okay? Okay, very good. Now, actually, this has never happened to me. It never actually has happened to me. I've never had 3 human beings make the claim that that I've made 6% per month, but that's what's happened today. What happens is we've got 50 humans in the room. Okay, 50 attendees now. That's what my attendance graph says. I don't know if you've got one or not. And then 27% of the room voted. Okay, so 27% voted. That means 13 humans. And then 15% of 13 humans. Well, I guess that wouldn't be 3. That would be 1. That would be one guy. Okay, so one guy said, you know what? Oh, and then we just had somebody pop in and say, I voted incorrectly. Sorry, Brian. Okay, Brian, how well did you do? How well did you do, Brian? Did you make 3% a month, or did you almost flat? Okay, all right. So Brian meant to hit the almost flat key. Okay, all right. So folks, we actually have no one in the first 2 categories. Then we have no one in the first 2 categories. No one made 3% a month. No one made 6% a month. It appears like somebody voted that way, but then Brian just piped in and said, no, I voted incorrectly. You probably meant to hit the next one. Okay, so anyway, 31% of the room saying I'm ahead, but not like what I was promised, and that's 31% of the folks that have done covered calls trading for 2 years or more. Okay, all right, and then 54% about flat. Honestly, okay. Now I'm thankful for this. Nobody said I'm losing money. Nobody said I'm losing money. All right, so that's good. But if you were losing money, there would be a simple explanation for it. Okay, and I'm going to give that explanation, and I'm going to also encourage you to maybe think about an alternate way to use your investing. Okay, now not everybody is a cover call trader. Let me do just one more quick poll. Okay, because we've got to set a baseline, and the baseline is for everyone. The baseline is for everyone. And after I show you what I'm going to show you, you tell me, was today worth it? Okay, we're 20 minutes into this talk, and I haven't given you any strategies. So I will be giving you the strategies just right after we get the results of this particular poll. Okay. All right, folks, thank you for responding so quickly. Now we're having a lot more participation in this poll, obviously because I didn't limit the field. I wanted everyone to participate in this one. And that does include those of you that did the cover calls poll. Go ahead and cast your vote again, please, so we get a real good, honest view of the whole room. We've got about another 5 seconds till the poll's been up for a minute, and then I'm going to shut her down, okay? So 3, 2, 1. Close. Okay, so let me share that. 38% of the traders, not everybody got to participate. Most of you did, but I know maybe some of you are calling in. 38% picked more winners and losers and won. Okay, that's easy to see. You pick more winners and losers and you're going to win. Very often. Doesn't always happen. 17% say, I picked more losers than winners and I lost last year. 17% more picked more winners and losers but still managed to lose, and that's a problem. In fact, that's horrible. I'm not saying you're horrible. I'm just saying that's a horrible story. You know, to know that you were right more often than you were wrong, but still overall lost money. Especially when there is a way, and I'm going to share it with you right now, there is a way to ensure that you don't get hurt. What it looks like is these folks, even though they lost less often than they won more often, right? They still lost money. So it looks like those losses were out of control, okay? Now, 25% said, I picked more losers than winners and still managed to win. Hey, and I think some of the folks that answered that probably have owned my book. You probably own the blueprint. I've done this in other crowds and gotten a 6% response or a 4% response. So today, 25% response. I picked more losers than winners and yet still managed to win. How about that? 4% say I'm ready to quit just to stop the hemorrhaging. I'm glad that you're here today. You're probably going to be glad that you're here today also as soon as I show this to you. Okay, folks, I need to know, am I back on the screen here? Do we have Einstein? Einstein says compound interest is the eighth wonder of the world, and my wow really comment here is for those of us that were promised 3 to 6% per month reliably in every market condition. Do you not see it? We're not seeing it? Still the poll? Okay, good. Thanks for your feedback there, guys. Let me see if I can undo the poll. Okay, and now do we have Jerry Maguire? Yeah, okay, very good. All right, so we're gonna get into that strategy now, okay, right this very second. Okay, so what's the problem? The problem, yeah, show me the money, says John. What is your problem? You know, why is it that you can be right more often than wrong and still lose money? Or why is it that you have to be right more often than wrong? Because some folks were wrong more often than right and still made money. So what's the deal? What's the problem? The problem is losing too much when you do lose, okay? And why hasn't it been solved yet? Well, we've been looking in the wrong place. We've been looking in fundamentals to convince us of, hey, you know, we're in a good company right now, okay? Or maybe we've been looking at technicals, and the technicals are to let us know what is going to happen next, as though what's happened in the past is a definite indicator of what's going to happen in the future, okay? We've been looking at the wrong places. And what I'm going to suggest is that there's something completely different at work, and you're going to see it now when we go to the poker table. And at this table, we're going to find a patsy, okay? Now, they say to cut losers short and let winners run, and that is the way to win long-term in the market, no doubt about it, okay? But there's often not the practical advice of how to do this, okay? So let's look at these players. We've got the covered call seller. That's one of the players at this table. And in order for the covered call seller to be able to covered call sell, there has to be a call buyer, right? There has to be somebody on the other end of that transaction. And then there also needs to be someone brokering that transaction, okay? Because the call buyer and the covered call seller are never going to meet. They're never going to shake hands, all right? But the market maker facilitates that transaction. And so all three parties are at the same table, and all three parties are going to come away with something, and all three parties are going to also come away having lost something. Let's see what goes on here. We've got a stock, let's just say XYZ Corporation, trading at $50 a share. And the $50 calls are bidding at $1.80, and they're asking at $2. Now, I know that you could probably place a limit order and get in the spread, right? You could sell at $1.90, right, maybe, or buy at $1.90, maybe, just depending on how long you wait and what the market is like and how unreasonable your limit order is, all right? But if we start with $100,000 and we're the covered call seller, okay, the covered call seller would use his $100,000 to pick up 2,000 shares of stock. So now he's fully invested. He's got $100,000 invested. If he's using margin, he would buy more. But let's just stay cool here, okay? Let's not do the margin thing. And then he's going to have the ability to sell 20 calls for $1.80. All right. Again, I know that you could probably get in the spread, but for the purposes of this illustration and keeping it simple, let's just say it's the $1.80. Now, here's what happens with another participant, the long call buyer. Now, the long call buyer also is a retail investor. He also has $100,000 in his account, and he's also betting that XYZ Corporation is going to go up. You see, you wouldn't buy XYZ Corporation and sell calls against unless you were bullish, unless you believed that the stock was going to go up, or at least sideways. Okay, so this fella also believes that the stock is going to go up. He doesn't use all of his $100,000. He uses $3,600, and he buys 18 calls for $2. Okay, so now the long call buyer has spent $3,600 for 18 calls. Now we know where the cover call seller picked up his $3,600. But there's a discrepancy between the top and the bottom. Can you spot it? The $3,600 comes from somewhere, and the $3,600 has gone somewhere. But what's the difference? What's going on between top and bottom? Folks, I'm asking you to text in and tell me what you see. What is the discrepancy? The market maker spread, says Bars. Okay, yes, the market maker spread. What you see is the number of calls. Yeah, the spread, the commission, says Dick Brown. Dick. Okay, all right, so let me go ahead and show you what has happened here. The market maker gets 2 calls, and he gets them for free, kind of. Okay, yeah, Karen picked it out, 20 calls versus 18 calls. Here, let me just go back. Okay, there's 18 calls talked about here, and there's only 20 calls, or there's 20 calls talked about here. All right, so the market maker gets 2 calls for free. You see, the calls are trading at $1.80 by $2, right? And the market maker has the unique ability to sell at the ask and buy at the bid. He's able to buy these calls for $1.80. So here's what happens. He brokers 9 transactions. He sells 9 calls, makes 20 cents each time. So now he's got $1.80 that he didn't really earn, and then that $1.80 he uses to buy a call, and he does that twice. Okay, so so 18 calls have traded hands, and then he ends up with 2, and the cover call writer has provided all of them. Okay, the cover call writer is the seller of all these calls. All right, so that's the deal. Now we know where everything has come. Okay, now if the stock goes to $55 a share, on expiration Friday, those $50 calls are going to be worth $5 a piece, okay? All right, now, the covered call writer sells his stock, and he keeps $3,600 that he began this whole thing with. He gets to keep it all, okay? Now, the long call buyer is able to sell his 18 calls at a $3 profit. Remember, he got them at $2 a piece, right? And now they're worth $5, so there's a $3 profit. So he does a little bit better. He makes $5,400. Okay, and the market maker, well, he seems to be doing the poorest at this table. He seems to be not doing as well as the others because he sells his 2 calls for $5 profit, having invested nothing, right? But there's the rub. Okay, he's made $1,000. Okay. Oh, somebody's Michael is asking what's the strike. Michael, the strike price was $50. $50 strike price. Sorry, that was a few slides ago. Okay. Just to remind everyone, you can, in the upper right-hand corner, anytime you like, if you want to take a screenshot, just click that camera icon, and you'll get a screenshot saved to your desktop. Okay, screenshot saved to your desktop. Okay, Michael, so you'll be able to track a little better if you do that. Okay, so here's the deal. Everyone here has won. Everybody wins. That's a very happy thing, okay? And sometimes at the table, a lot of folks will win, all right? Everyone wins. So let's do it again. For the sake of illustration, okay, let's say that it's going to be the same stock. The stock has perhaps gone back down to the $50 level, okay? And so and looking out another month, those calls are $1.80 by $2, okay? Now the covered call writer sells 20, again, at $1.80. The long call buyer buys 18, again, at $2, okay? And the market maker owns 2 and has a $0 cost basis. Now, A stock that can go up by 10% can also come down by 10%. And so in this case, the $50 stock that we were trading $50 calls on goes down to $45. Well, those $50 calls are going to be worthless on Friday, aren't they? The long call buyer is going to lose his entire investment. He spent the $3,600 that the covered call seller picked up, right? So he's going to lose all that. That's all gone. Now, the market maker loses nothing because he doesn't have any skin in the game. He actually is able to trade without paying. He gets to play but not pay. All right? But the covered call writer, he keeps this $3,600. Yes, the $3,600 that the long call buyer lost. But in truth, if we're going to be honest with our accounting, in truth, he's lost $10,000 on the stock. Okay, so it's a net loss of $6,400, right? His stock went down by $5 a share, and he had 2,000 shares. Remember? All right, trading $100,000 worth of shares. All right, so he has 2,000 shares at $50. The stock goes down to $45. Now he's lost $10,000, which is offset a little bit by his $3,600. He loses $6,400. So here's our zero sum after all the trading. The long call buyer in the winning play wins $5,400, but in the losing play, he loses $3,600. He's still ahead. He's ahead by $1,800. The market maker loses $1,000. I'm sorry, makes $1,000, okay, but then loses nothing even when he's wrong, okay? And then the cover call writer makes $3,600 in the first play, but loses $6,400 in the second play. Now, it's easy to see where the cover call writer makes his money, because when the long call buyer loses what he has supplied the cover call writer in the first place, that's where it comes from, right? But the long call buyer and the market maker picked up the $6,400 that he lost. See that? Now we have an explanation of the zero sum here. All right, and what we're doing is the reverse of cut your losers short and let your winners run. When we cut our losers short and let our winners run, we're making sure that we don't lose too much when we're wrong and that we do very well when we're right. But in the case of the cover call seller, we're actually cutting our winners short, aren't we? You're sorting the good stocks out of your account, and you're being able to keep the losing stocks, okay? So the conclusion is, well, the long calls buyer was the savvy professional in this case, and the market maker in this case was the house, and the cover call player was the patsy, okay? Again, reminding you, I'm not calling anyone a patsy. I'm not pointing the finger. Here in a moment, I'm going to show why he was the patsy, okay? This is a happy table. All they needed was someone that would agree to take less on the way up and also agree to risk more on the way down. Now, it's not that cover call selling by itself is a poor strategy, okay? It's not that. It's that the structure that these people followed structured it against him, okay? Because the one retail player, the cover call player was willing to make 3.6%, but the other one was only willing to risk 3.6%. Do you recall that? He started with $100,000 as well as the cover call player also started with $100,000. And comparing the two strategies, the long call buyer won overall, even though he was right once and wrong once, and the cover call seller lost overall, even though he was right once and wrong once. Okay? Now, if that long call buyer had simply bought stock, if the long call buyer had, I'm sorry, not bought stock, he had simply bought calls, but he risked it all. If he bought all that he could afford to buy, in that second play, he would have lost big time, right? He wouldn't have lost a small amount. He would have lost everything, okay? So structuring and position sizing is what's important. And what did you not know was possible? Well, what's possible is that you can use the married put strategy as a way to protect yourself, not to get hurt while at the same time reversing the situation that a covered call seller has. It's not that selling covered calls by itself is a bad idea. It's just the way that this fellow structured it. He had too much at risk. He used all $100,000 of his capital to buy stock and then used that to sell calls against. But the long call buyer structured his account well. He had the same amount to begin with, but only traded a portion of it. He only traded a portion of it. Okay? If the long call buyer had bet everything, he would have lost everything when he was wrong. Okay? So what we need is to have a structure, a position of strength, and this is where to begin. And then from that position, any move can be advantageous or at least minimal risk. In fact, even selling calls might work. All right? And I'll be sharing that here with you in a moment. Now, I see that a whole bunch of questions have popped up, and I'm going to go ahead and address those real quick, but I think you'd probably like to see the meat and potatoes of this strategy. Okay? Okay. Michael wants to know if he was selling covered calls at the money. Yes. Richard says the covered call writer made much more at 55. No, he didn't. The long call buyer did. How about the 3,600 plus 5-point gain on 2,000 shares? No, see, when you're a long call buyer, you don't own any shares. Oh, I see. Richard believes that this person still has his shares. Richard, when you sell calls at the $50 strike and your stock is at 55, either you deliver those shares or you spend more money than you took in to keep them. Okay? Either you deliver those shares or you spend more money than you took in to keep them. And so in this case, it would be spending $5 per share for 2,000 shares to hang on to that stock, and he only received $1.80. Lost the picture. No, actually, it should be blank. It should just be blank. Okay, so I'll go on from here. Very good. All right, so folks, stay with me here. Okay, Richard wants to point out that, hey, you know, that stock gained and he's still in the stock. No, he's not. He's not still in the stock. Either he's not still in the stock or he didn't have a gain. All right, so let's go ahead and take a look here at my strategy. This is how I roll, okay? And within the last, it says within the last 12 months. That's not a true statement. This is an older frame. And I brought in this older frame because I wanted to illustrate something. I'd like for you to look up Altera's strike price now, what price it's trading at now. Altera hasn't recovered, I don't think, okay? But in 2010, I played Altera twice in 2010, okay? Now, I'm using an older trade just because this particular trade really fits the example and the math very well, plus the fact that I played the same stock twice in that same 12-month period. Now, the first time I played it, I made 12% on my money. Oh, okay, Karen just piped in. Karen says that Altera is trading at 36.39. Okay, and Larry just piped in too. 36.39, great. Okay, and that's the second reason I'm using a dated trade, because I want to show the folly of following this covered calls trader guru idea that, hey, it's not a loss until you sell. It's not a loss until you sell. Oh, really? Okay, so here's the deal. Altera Technologies, I played it, 12% I made on my money. Now that's 12% on the stock and the put. I spent money buying the stock and buying put options. And the 12% that I made on that was based on the whole amount. Okay? All right. Now the stock went up 17.3% and I only, made 17.3. The second time I lost 5.6%, even though the stock went down in the period of time that I was trading it. The stock went down 21.8%, and in fact, it continued down. It went down to 31%. But if I had continued to hold, my loss would still be only that single-digit amount, that 5.6%. Okay, even if I had held on to the stock for another 6 months, and it went down by 31% or more, I would have only lost 5.6%. Okay, so why is this significant? Okay, well, let's talk poker again. Here are the folks at the table: the stock seller, the naked put seller, the market maker, and me. September 14th, 2010, here's what happens. I buy 500 shares of Altera at $27.35 a share, and at the same time 5 put options. Now I'm going to show this as just a single 100 share lot and a single put option because that makes math easier, okay? But in fact this was 500 shares and 5 puts, and you can scale it however works for you. If you're a really big fish, you could buy 50 puts and 5,000 shares, okay? And if you're a smaller fish, like I was when I first started trading this strategy, you'd buy 100 shares of stock and 1 put, okay? But here's the deal. The combined cost here ends up being $30.85, and what I've done is I've taken my money like if I was trading cover calls and put it into stock, and then I've also hedged it with an option. But my hedge does not include taking income yet. It doesn't include taking income what? Yet. Now, there are 12 different ways to take income out of this arrangement. Use your imagination. You'll probably come up with 3 or 4. But in truth, there are 12 ways that I've discovered and proved with real money in real time with people looking over my shoulder over the last 12 years. Okay, so the total invested amount is $30.85. But my guaranteed exit is $29, okay? So I can definitely get out at the $29 strike price or better anytime between picking it up and 6 months later, okay? So the total amount at risk is the difference between what I've spent and what I'm guaranteed to get back even in the worst of circumstances. So it's $1.85, or $1.85 divided by $30.85 is, hey, that's 6% of my capital. Now what I've done here is I've forced myself into a position where I'm trading all of my money. Well, actually it wasn't all, I had a $100,000 account at this point, $115,000 I think I was trading, and I only used about $15,000 of it, all right? $15,425, that's what I used. Okay, but the point is, out of the money that I put in, all of that money, only 6% of it's at risk. So I can't get hurt too badly if the stock goes down. I've kind of forced myself into that position to where I can't lose too much. Okay? Now here's what actually happened the first time. The first time the stock went from here to here, and I got out. All right? Now the stock itself advanced by 17.3. And I call this a radioactive profit machine when you buy stock and put the way that I do. The RPM only made 12%. But again, that only is based on not just what I paid for the stock, but what I paid for the stock and the put. Okay, so it's actually more like, it's more like 14, 15%. I'm capturing the whole move. Okay, now here's the thing. A little bit later that same year, the stock was trading at a much higher amount. It was trading in the $50, $55 range. I bought stock and also $55 put options. Now, buying stock and buying $55 put options, the stock went down. And at one point it started to recover, and I thought, well, it's going to recover a lot, and it didn't. And then I thought, well, it's going to recover, and it didn't fully. And then finally I said, okay, that's enough. I'm out. All right. The stock went down by more than 21%. And even if I had held on, the stock went down more than 30%. And even if I had held on for another 6 months from here, if I had held, no, I'm sorry, 7 months. If I had held on for another 7 months from here, I still would have been able to get out at just a 5.6% loss. Okay, now take a look over here. If you're winning 17.3 when you're right and losing 21 when you're wrong, and it's the same amount of money both times, you're behind the curve. But again, here the stock is trading 30-ish and I'm buying 500 shares. Here the stock is trading 50-ish and I'm buying 300 shares. So it was about the same amount of capital in both plays. But here I was right and made 12%, or about $1,836 after commissions. And here I was wrong, and I lost 5.6%, or about $900. Between the two plays, I'm wrong half the time, and when I'm wrong, I'm really wrong, right? But still made money. Between the two plays, made over $900, nearly $1,000 after commissions, even being wrong half the time. Now, I know that a lot of folks will say, well, Kurt, you could just do that with a stop order. Well, could you? Look at this. This is an actual trade I got into. I saw a nice double bottom pattern with Digital River. Investors Business Daily put it in the 99 percentile with earnings. I said, yeah, Digital River looks good. And I bought Digital River, and I also bought put options. And 2 days later, it fell by over 40%. Now, if I had perfect knowledge of what would happen in the next 13 months, I would have held all the way to this day and sold at the same price that I got in. Okay? If I had perfect knowledge, perfect foreknowledge. But you know, I didn't have perfect foreknowledge. What I did have was a put option. And my put option got me out of this position with an overnight 5.7% loss instead of a 40% loss. Can you imagine? Look at this volume. Can you imagine trying to trade a stop order or trying to cancel a stop order so you didn't get, your butt handed to you, 40% haircut overnight? Okay? Well, anyway, that's what the put options are for. It's insurance. By the way, can you pick out the patsy that was sitting at the table? You see, I was sold stock twice, right? The first time I was sold stock, it went up. Okay? So if that fellow was selling short, he lost. But the second time I was sold stock, it went down, and it went down big time. So if the same fellow is selling me stock, guess what? He won one, and he lost one. But when he won, he gained quite a bit more. So he was not the patsy sitting at the table. Was it me? Oh, heavens to Betsy, no. I did very well. Between these two plays, even though I was wrong half the time, and even though I was more wrong than I was right, well, I still made money. Okay? So I wasn't the patsy. But what about the seller of the puts? Okay, now Larry and Karen went out and found for me the price of Altera today. Now this is about, what, 4.5 years later? 4.5 years later, you know what? Altera Technologies has not recovered its position. It has not gone up to $50 a share again, I don't think. Okay, maybe you could check the chart, but I don't believe that it has over the last 5 years. Okay, and the thing is, the fellow that sold me the puts, the first time the stock went up and his puts would have expired worthless and he would have kept his nut. Okay, but the second time he ended up on the hook, didn't he? Selling me a $55 put, and it went down to $32 a share. It went down to $32 a share over the next couple of weeks. Okay, and then it never has really fully recovered. And Karen and Larry let us know that Altera is still trading at $36. Okay, so folks will say, well, you could just keep rolling the put. And that's what pure options traders would say. That sounds kind of tiring after 4 years, don't you think? What about covered call sellers? Well, you bought the stock at 50 thinking it was going to go to 55. So you sold the $55 call and it went to 32. What are we going to do about this? Guys, here's the thing. The structure of buying a stock and selling a call against and capping your upside is bad news. Okay? Bad news. By the way, if let me rewind here. I'm going to rewind to right here. If I had sold a covered call here in this 6-week period or 7-week period, would I have made 12% on my money? Heavens to Betsy, no. If I had sold bought at $27.35 and sold a $28 call or sold a $29 call, the most I could make is, my 3, maybe 4.5%, 6%, whatever. I'm not going to make 12%. No. Okay, so that's the idea with structure. Okay, now I'm going to show you something even cooler. But before I show you the even cooler part, okay, before I show you income methods, I'm going to show you an income method that will leave the upside open and at the same time take income. Okay, it'll leave the upside open and it'll take income. But I would like for everyone to just think about what I just showed you for a moment. Okay, if you traded last year this way, to where you force yourself into a corner that you could not lose more than 5-6% on a trade, and yet you left your upside open to where you could have double-digit gains. Let's not even consider the gains. Let's only consider the losses. If you never took a loss last year of greater than 5-6%, would you have had a better year? Yes or no? If you say no, okay, I'd also like to hear from you what kind of trading you're doing. And if you say yes, see where you end up on this scale. So far, everybody so far has said this would make a difference between a losing year and a winning year. Oh, and now we've got a little bit more diversity. Some other folks have come in. Now we've got three categories filled in. Okay, I'm going to leave it up there. I'm going to invite somebody to tell me what's going on if you're in that first category. Another sip of coffee. Okay, I'm going to close that poll. I'm going to share the results. Not a one of you has said to me that limiting your risk to 5% would not have helped your trading last year. Wow. Do you realize that I just totally made you a winner? Look at this. 8% say I might have still lost last year, but would not have lost as much. Okay, so if you lost less, that's suspiciously close to earning more, you know? I mean, maybe it's not the same as earning more, but you've got more left over than you had before, right? So that's 8% of you. 77% said this would make the difference between losing and winning. I just made you a winner. I just did that. And for free. You know, I'm not asking for anything. I'm going to give you some details on how to get the blueprint later on. Okay. But first I'm going to have to show you the value of the blueprint. Okay. Now 15% said I did well last year, but I would have done even better. Oh, okay. So, you know, losing less, even though you won last year, losing less is a value to you. Okay, good. Well, cool. Let's see how this plays out because first off, I'm going to answer an objection, and then secondly, I'm going to show you an income method that I think is going to blow your socks off. I think you're going to extremely get a kick out of this. Okay? Now, when I've shown this to people, they have told me, why are you raising the cost basis so much? You invested $30.85, that's $27.35 for the stock and $3.50 for the put. You're spending more than 10% of your capital that you're investing on put options? You know, you can't make a dime, Frankenberg, until Altera makes it from where it is at $27.35 all the way to $30.95. Well, guess what? That's just not so. It's just not so. Folks do believe this, okay, because of what they've been told and what they've been taught about how the married put play works. But remember, I'm not doing a traditional married put play. In a traditional married put play, as the stock goes up, the put comes down quickly because it's only a month away and usually it's out of the money, okay? But that's not what I did. I bought stock and a very expensive put option. But you get what you pay for. Watch what this does, okay? Oh, by the way, I'm going to be sharing the income methods, or one of the income methods. And the income methods are used to reduce the gap. So we're starting with this $30.85 expense, and only $1.85 can be lost, so 6%. But afterwards, we can take income and may even be able to reduce all of our costs on the put. So what would you say if I told you that this whole thing that I showed you here was bulletproof, meaning I could not lose way before that stock ever even touched $30.85? Here's the deal. I'm going to show you income method number 3, which we call the bulletproof vest. It's one of 12 different income methods, and it's one of the income methods that leaves your upside open. My favorite kinds, okay? And we have a number of income methods that leave your upside open. But this is one I feel comfortable just giving away, all right? So here's the deal. When Altera went from $27.35 to $29.40, some interesting things happened, okay? Now that's well below the break-even price. A lot of folks look at that. I spent $27.35 on the stock and $3.50 on the put, so it's $30.85 total expense. But when the stock went to $29.40, interesting things began to happen. It was possible for me to take a credit and still leave the upside open. And we'll see why that is in just a moment. I call this the bulletproof vest. It's income method number 3 in your blueprint. And what we're doing here is selling to close the March $29 put option. Now remember, this was put together in September. The stock has moved up. Now I'm doing this on October 15. October 15. And what I'm doing is I'm selling the March $29 put option for whatever I can get for it now, and in its place buying a November $30 put option. Now this is March 2011 and this is November 2010. And the date happens to be October 15th, okay, 2010. So this is a month away. It's a month to expiration. Now why is this lower? Why is this $30 put going to cost me less than this $29 put? Well, because of time value. This is so far away in time. This is still 5 months out, I think 5 from October. Let's see, November, December, January, February, March. Yeah, 5 months away. It's still 5 months away. And the November put is just 1 month away, and that's why there's a difference. Now, here's what happens. By swapping those puts, by selling this put and in its place buying this put, I take 90-cent credit. Now, if I was just opening this trade, it would be kind of bizarre. It'd be like a reverse calendar spread, wouldn't it? If I was selling to open and buying to open simultaneously, yes, I would generate a credit, but it'd be kind of weird. It'd be like a reverse calendar spread, okay? But in fact, Options Express treats this as one transaction. They treat it as a spread trade, okay? So I'm doing one commission and picking up 90 cents per share, okay? Now, what I've done simultaneously is raise the payout by $1. Now, here's the deal. The original purchase of that put option, it was $3.50, and at the time, the stock was trading at $27.35. So, $1.65 of that is intrinsic value, and $1.85 of that is time value. Now, about a month has gone by, and the stock has gone up. And as the stock goes up, dollar for dollar, the intrinsic value falls away, dollar for dollar. As the stock goes up 1 penny, the put comes down 1 penny. As the stock goes down $1, the put would go up $1. At least the intrinsic value of the put would go up $1. Does that make sense? Okay, so what's happened here is, yes, the put itself has lost value, but that's okay because I own the put and I also own the stock, and the stock has to go up for this put to come down. And since I own them both, it's a wash. I don't lose any money. Okay, so that puts price has gone down from $3.50 to $2.52. It's gone down 98 cents. Okay, but if we just consider the time value of the put, the time value was $1.85, and now it's all time value. It's $2.52. This is an interesting phenomenon. It's because I bought that put in the money and far away in time. Because it was in the money and now it's not, the time value has actually swollen up. Isn't that something? Even though time has gone by. I bought this put in September and now it's October and the put's time value has gone up. And folks will say, well, what about the absolute value of the put? You know, the absolute value was $3.50. Well, what about it? It's offset by the fact that my stock went up by $2.05. Okay? So the time value expands. It was at $1.85 and now it's $2.52. And the actual value of the stock has also expanded, and I also have it. And guess what I don't have? I'm going to point this out to the fellow that wrote me earlier. Well, what about your gain in your stock? Hey, guess what? I do have a gain in the stock that I can reckon. I don't have a call sold against it. So now the cost basis of the stock and the put originally was $30.85, right? Okay. Now by selling the far put and simultaneously buying a near put, I take 90 cents of that out. I extract it. So now I've still got a position that's in place that's worth $30 no matter what, but the cost basis is only $29.95. That's what we call bulletproof. There's no at risk anymore. And I did this, the reason I did this was because there is an earnings announcement coming up November 4, and November options expiration was after November 4. So I didn't know what was going to happen. I didn't know if the stock was going to go up or down, but you know what I also didn't do? Care. Also didn't care. Now, I should also mention that in this time frame before this day, before October 15 when I bulletproofed it, I also pulled in 70 cents from income method number 5. I don't have the time or the ability to share all that right now. But the fact is, instead of an at-risk amount of negative 5 cents, I had an at-risk amount of negative 75 cents per share. So I'm sitting on 500 shares of stock with 5 put options, and the cost basis of the stock is less than the strike price of the put going into earnings. Isn't that cool? Okay. All right. So I'm going to ask you guys, what do you think about that? What do you think about that income method that I just showed you? You can use the income methods to trickle away the cost basis little by little, like where I captured the 70 cents. Okay. Or you can sometimes in a big move like this, you can completely remove all the risk. And that's all I've shown today. I've just shown the one bulletproofing move that removed all the risk. But what do you think about that? Kind of cool, right? All right, so we're getting a lot of response here. I'm gonna take another sip of coffee here, folks, and then we'll look at the results, and then we'll talk about how this applies to you. All right. I'll leave that pull up for another 5 seconds. And 3, 2, 1. Close it up. Oh, interesting. At the last second, we got a tie. Okay. Okay, so the winner is 60% of the room says, I want to know more about riskless spreads like this. Yeah. It's kind of exciting, actually, to be able to do a spread trade or set up a trade like this where your upside is still open. And doing that spread itself doesn't have risk. And now the RPM doesn't have risk either. Second place, this one trade made it worth all the time I spent here today. Thank you. I thank you for that. Really do. 40% say trickle away the cost basis little by little. I dig. Yeah, you get it. You get it, don't you? It's kind of cool to be able to take away the risk, but then still leave the upside. Okay? Now, 13% want to know, can you do this in an IRA account? Absolutely. Everything that I showed you could do in a Scottrade account. You could do it in a Charles Schwab. You could do it in just about any account where the broker, even if they're super stodgy, and unenlightened. You could do it in that kind of account if you're able to trade covered calls. This is less risky than trading a covered call, and it is available. I especially like bulletproofing. 13% say, is it really possible though? Okay, guys, I didn't just show you a unicorn. Okay, I didn't just show you something that happens every blue moon. I showed you something that is commonplace. We're constantly bulletproofing stocks, and with 12 income methods, we're doing it lots of different ways, and it's kind of cool. Lots of different ways, lots of different types of markets. So that's what I wanted to share with you there. Now, I'm going to have some other things to share, maybe even give you a fuller explanation if you like. Okay, but I'll just let you know what the outcome was of this. I did it just before an earnings announcement. Was able to go ahead and take advantage of that stock's run up and make 12% on my money, and that's 12% based on the original investment of the stock and the put, not just 12% money on a put going down or 12% money on a stock going up. It was 12% on the whole trade, and bulletproof for a significant amount of that time, for 4 weeks of that 7 weeks. Bulletproof. Okay, kind of exciting. Okay, so let me see here. Oh, you know what? We already asked this question. I said this. I said, think about what I just showed you with regard to the limiting risk on the front end. If every loss you took last year was scaled down from whatever it was to 5% or less, would you have done better? And everybody that answered said yes. Okay, so now let me give you another question. How much? How much better off would you be? How much better off would you be? Nobody said it wouldn't help, but I'm going to ask, how much better off would you be? Let's leave that pull up there for just a few seconds, and I'm going to address some of these questions, okay? Larry wants me to look at a play here. Larry, give me just a minute, and I'll be able to do that. Oh, I can spot your problem already. I can spot your problem already there, Larry. Okay. Larry, do you own the blueprint? I'm asking Larry, do you own the blueprint, sir? No. Oh, okay. I would highly recommend that you make that investment. Okay, you wouldn't have gotten into this trouble if you did have the blueprint and follow the directions inside. Okay, but I'll go ahead and show what your problem is. Now the thing is, you're not getting hurt real badly. Okay, you're not getting hurt real badly, but your situation would be a lot better than it is if you have the blueprint and follow the directions inside. Okay, so I will address your question. Let me go ahead and close the poll here. I'm going to share the results. Here's what I got. Nobody said it wouldn't have helped. 67% of those of you that answered the poll, 67% say I'd be ahead by $1,000 or more. And 33% said this would have made at least a $5,000 difference last year. Well, listen, the blueprint costs $350. That's why I've got that number up there. Okay, the blueprint costs $350. So you would have the opportunity to get the blueprints and for yourself and one for each of your two closest friends, okay, that trade, and still be clear, because guess what? You're not just going to trade this year. You're going to trade next year and the year after that and the year after that, right? So having the blueprints last year would have done pretty good for you. Okay, 67%. Be ahead by $1,000 more. 33% would have made a difference of $5,000. Okay, very nice. Okay, so I've got the question from Larry. Larry, I'm going to go ahead and address your question here in just a moment. First, I'm going to talk about the blueprint and where you can get it, okay? And then we'll go ahead and answer that question, not just for you, but for everybody, because I think it really illustrates the value of having the blueprint versus just coming to a free webinar and playing radioactive trading. You know, you could either do radioactive trading or you could play radioactive trading. And so I'm going to go ahead and share that with you, okay? Now, being able to reduce your gap to less than zero makes it so that whatever your cost basis is, here at the dotted line, now the strike price of your put guarantees that you get out at a higher price, whether the stock goes down, and if it goes down, you still get out at a higher price, or whether it goes up, and if it goes up, there's no limit to how much it can go up. This is not an exaggeration, okay? I don't make a whole lot of claims as to numbers and what they could be, okay? But I will say that we've had subscribers come through and make a 40% gain after bulletproofing themselves. Myself, in Amazon, I saw Amazon quadruple in value after my bulletproofing opportunity. It quadrupled in value. Okay, now this was back in 2002, and you know, Amazon was getting a little bit of buzz, but it wasn't really a profitable stock yet. Okay, but in fact, folks, leaving your upside open and then taking care of your downside, even if you experience the downside, you don't experience too much. Okay, it's kind of cool. Okay, so having said that, now I would like to see if there's any other questions before I share the links. Okay, going to see if there's any other question before I share the links. And then we'll take a look at Larry's play, and I'll show him why it makes sense, you know, for you to have the blueprint. By the way, you can vote in more than one category here, and I just wanted to get a little bit of feedback from you. This is my last poll. I'm not gonna poll you anymore. I just want to get some feedback from you. What do you think about what I've shared with you here today? Okay. Very nice. All right, you're going to leave that pull up for another 3 seconds, 2 seconds, 1 second, and we're actually a few seconds shy of a minute. Okay, 7% said, I don't think puts can protect me like you showed. Well, then you have a problem with our current system. Essentially, you believe that the laws will be abrogated. You know, when you purchase a put, it is a contract. It's a legal and binding contract that guarantees you the right not the obligation, but the right to be able to sell your stock at the put strike price. So it does protect you, like I showed, and it has ever since we've been trading standardized options since 1973. So yeah, it will. 14% say, I don't know if it's worth it. Let's hear the offer. Well, the offer for the blueprint is $350. There are some bonuses. 29% say, wow, this is just what I was looking for. Guys, if I had access to this back when I went to that weekend seminar, I never would have fallen for it. I never would have gotten hurt, and would have enjoyed, like I have now, taking gains every year. 21% say, I've paid over $3,000 for a less complete solution, and 57% say, I like bulletproofing. Awesome, I like it too. Okay, so the blueprints, the reason that it makes sense to get the blueprint now is that it's $350, okay? $339 plus $11 shipping in the United States and Canada. If you live outside of the United States and Canada, the shipping's a little more, okay? I don't know what it is for your particular country. We've shipped the blueprint to over 38 countries. Why don't we do it by PDF? Question popped in there. We don't do it by PDF because you know, it's so easy for the bad guys to copy. Okay, it's so easy for the bad guys to copy, and we have had a bit of a problem with plagiarism, but you know, imitation, I guess, is the sincerest form of flattery. So the blueprint is only available as a standalone physical product, and we have the addresses of everyone that's purchased it. That's a good thing because it helps keep out the baddies, and it also guarantees you blueprint owners that you get guaranteed updates for life. Okay, so there's that, the blueprint. There are a number of there's also an upgraded version, the home study kit. The upgraded version is $5.99 plus shipping, and that includes not just the blueprint for reference, but also a number of CDs, video CDs that you can use to learn a little bit more quickly, if that's how you learn. If you're more of a multimedia type of a person, this is a better value. And if you are better with just text and pictures, okay, text and charts, then the blueprint is a better value, okay? All right, and so if you've been on the fence, there's some awesome bonuses. There's a 100% guarantee. I mean, if I'm going to talk about bulletproofing, why not give a bulletproof offer? So if for example, you order the blueprints and you get it in the mail in a couple of days, and you read through it and you say, you know what, I'm going to try this out for 30 days. I'm going to paper trade it, or I might even trade it with real money. But whatever I do, I'm going to keep track of what I made versus not getting into the trade at all, or what I saved versus not having any protection at all. And if that amount is greater than what I spent on the blueprint, I should feel kind of silly about trying to return it. But on the other hand, if what I share in there takes your trading and turns it around like it has for so thousands of many others, you're going to probably want to keep it. Okay, we do process returns, and we do it very quickly and cheerfully, but we hardly ever need to. You know, the blueprint is not something that most folks want to get their mitts off of after they have it. Okay, so you know what? I'm not going to go through the bonuses because that's going to prevent me from being able to answer Richard's question. Or I'm sorry, Larry's question. Larry got into a married put play that he did not do radioactively. Okay, so you know what, folks? What I'm going to do right now is I'm going to formally close today's presentation. I'm going to give you a link. Let me go ahead and send this link out to you that are attending live. I'm going to give you two links, actually. www.poweropt.com. Okay, /RAT. That's a link that I've just sent to you. And what I'm going to do here, folks, is actually go in there, poweropt.com /RAT. This is how we're going to look at Larry's play. Also, I'm going to give you another link, okay, www.radioactive trading. Whoa, got to do radioactivetrading.com. There we are. And if you go to the products page, okay, that will give you this. But I'm going to give you a special link. Special link for those of you that are in the live class. And it may still be up for those of you that are watching a recording. Iridium, the chemical element iridium. Okay, I'm going to go ahead and click that, and you'll see that there's some bonuses, 5 bonuses that are not included in our regular offering, okay, for both the home study kit and for the blueprint. Okay, so I'm going to send that out to everybody. Hang on just a second. I'm sending this out to my live folks, radioactivetrading.com/iridium. Okay, that's a clickable link that I sent to everybody on the chat. And if you are watching the recording later on, then guess what? Hit that and you will be shown these 5 bonuses that total more than what the blueprint costs. Okay? All right, cool. So now what we're going to do is go ahead and take a look. I'm formally closing now. Okay? We're closed. We're done for business. Thank you for coming. Have a nice day. Happy trading, and pick up the blueprint if you haven't already. Okay, now I'm going to answer Larry's question because it deserves an answer. And Larry had put in, Caterpillar. Okay. Oh, I traded Caterpillar here recently. I made a pile of money on it, actually. I did okay with it. Okay, well, let's see what Larry did. Larry got into Caterpillar. We're going to go to the custom spread tool here. And you picked up, gosh, what put option? It's a May 85 put. Okay, good. So we can still look at this. Okay. How am I going to do this? I'm trying to make it so I can see your numbers and also see my screen. Okay. So this is for Larry. Caterpillar. Going to go to the options. Now, you picked up the May. You did this with 300 shares and 3 puts. Okay, I'm just going to, for the sake of simplicity, I'm just going to use 100 shares and 101 put. Okay, so it's the May 85 put that you got. Okay, great. And you also picked up stock. Okay, so you got 100 shares, 1 put. Okay, the put options were $4.85. Very nice. And 90.60 is what we spent on the stock. Okay, now the stock dropped. The put has gone up. What did I do wrong? Well, here's what you did wrong. You bought a put option that was not in the money. Okay, and so your losses, the green line here shows where you are now. Red is where you could get out between now and expiration. So maybe your loss is about $1,000 here, Larry. Okay, so that's your loss right there. And you know, do you have the opportunity to recover? Yes, but it's just not likely. You're not likely to recover. You might hold because guess what? There's not a whole bunch more that you could lose. You've lost 1,020 and at expiration you're going to lose 1,045. So the possibility is, you know, you might be able to get some of that back. We don't know what Caterpillar is going to do. But the point is you risked double digits there by not doing this correctly. Okay? All right. Okay. All right. What put should I have bought, says Larry. Okay, well, let's take a look. It's not profitable for us to look at that, what that is today. Let's look at what you should have done. Okay, all right, so what we'll do is we'll go take a look at the chain. And what date was this that you entered the trade? Oh, it's 12/12/14. Okay, 12/12/14. All right, so let's go ahead and take a look at the date. And guys, thanks for bearing with me. You know, again, class is dismissed. All right, class is dismissed. But what we're doing here now is looking at what it would have been, what Larry should have done if he was going to be trading radioactively. Okay. Okay, so let me go ahead and get that chain. This is only the end of day data, all right? But it's the end of day data for December 12th, Okay, and yes, you want to look out about 6 months. Okay, but what this fella did, Larry did, was he bought an out of the money put, which is losing money quickly because of time value, right? So losing money quickly. What I would have done instead is if it's at trading at 90, you buy a 95 put. Okay. Where's my May? Here it is, May. And what are our $95 puts trading at? Well, they're 1380 by 1490. That's a big spread, really big spread. Here's a tighter spread. There's only 55 cents there instead of $1.10. Okay, so let's just say that I would go for the tighter spread first off, and I probably wouldn't be buying in at the bid. You buy your stock and your put with a limit order. You can buy them both at the same time with a limit order. Let's say we get filled at 1565, right in between here. Okay, so 1565 for the May 9750 put. What was it again? 1560. I got to look at it again. Gosh darn it. Sorry, guys. Hang on. It was December. 1565 is what we'll say. 1565. Okay. Oops. Custom spread. Come on. Now, we're going to have the same cost basis. And we're going to also get the May 9750 at 1565. Ta-da! All right, now, what this is going to show us is that, first of all, your losses would be less. Okay, so instead of over $1,000 losses, your maximum risk is $875. Okay. Also, during that time, we might be doing income methods. Okay, and we've had income methods with probably with opportunities to capture $2 or $3 every month, since December. But let's just say we've done it twice. Okay, so that would bring down your cost basis by, say, $4. Okay, now don't get me wrong, you're still in a losing stock. It's a losing situation. Okay, but what have we lost? A darn sight less than $1,000. Your loss is not in the double-digit zone. It's only 4.6%, okay? And this is what's available when you have done something wrong, okay? All right, Rhonda says, doesn't look like you selected May 15 puts. Did I not? Yeah. Yeah, those are May. Those are May puts. Yeah, and there's not a lot of time left over. You see, in truth, you would probably want to get out way before this. If that stock is headed south and you've only got single-digit risk and it starts to go south, it's not doing what you expected. You can get out. Say you started with a 6% risk, you can get out with a 3% loss or a 2% loss. I've even gotten out when the stock went down by 11%. I got out with a 0.1% gain, okay, by structuring the put properly, doing an income method, and seeing that the stock was going down. I didn't think it was going to recover, so I just got out way early, ended up with a small gain for my trouble. Kind of interesting. Okay, all right. So, oh, you're welcome. Yep. Long-term expected returns, says Dick. Dick, I don't make those projections. That's what distinguishes me from these cover call gurus. They'll tell you, 3 to 6% per month. I never do that. I never say what you can make. I say, because I can only honestly say, I say what you could lose. How about that? It's a little streak of honesty. Now, have I and have my friends done well? Yes. Have Radioactive Trading students done well? Yes. Mike Chepka, for example, lost in 2008, like a lot of us did. A lot of us lost some money in 2008. I lost almost 4%. When that stock market went down with that big crash, I nearly lost 4%. My friend Mike Chepka lost 1.5%. Now, since then, both he and I have had double-digit gains every year, but it's not the double-digit gains that we want to brag about, is it? It's the fact that when there's a terrible year, when folks are down 40% or better, Mike gets out with a 1.5% haircut. You know, I lost 3.8% of the of the gains that I had up to that point. So, you know, great explanation. You're welcome there, Larry. I appreciate that. All right. So, folks, I'm going to go ahead and close her up for real now. I hope I've demonstrated to you the value, maybe not of the blueprint. You know, the blueprint has got 12 income methods, and I can't possibly go through all of those. But hopefully, I have given you the value or shown you the value of limited risk trading. You know, when you buy stock, also buy a put option and know how to do it right. You know, Larry would be better off by more than what the blueprint costs had he owned the blueprint. Okay, so Larry, I'm chiding you a little bit there, but you get it, right? Okay, and folks, as far as our guarantee, you know, the guarantee is that you'll either make or save as much or more than the blueprint costs you. So far, our class today has all said that the blueprint would have done them good. Okay, so I'm going to urge you to go pick that up. Yep, you're welcome. And Larry says yes, he gets it too. Okay, folks, you're the best. I will see you out there, and happy trading. Bye for now. As always, if you think of a question that you didn't pose during the class, or if I did get your question, I think I did get to everybody's, but if I did get your question, please send it to me at support@radioactivetrading.com. Okay? All right, we'll see you out there. Bye for now.